Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about Okta. Okta just reported its Q4 results, Q4 2022, and they pointed out some strong guidance for the year ahead, slightly above what they previously talked about, which was for 35% year-over-year growth. So it's actually going to be closer to 38% year-over-year growth, so that's obviously really strong. Management talks about the acquisition of Auth0, and that is impacting, as it's an early stage business, and that's impacting its profitability profile of and overshadowing Okta's standalone business that has a better margin profile. However, looking at this from different angles, I mean, it's quite difficult to see how it's not the case that the more that Okta grows, the less profitable this business becomes. All considered, I think that paying 16 times forward sales for this business is probably on the punchy side. I think that investors will do well to avoid this name. So I'm going to dig right in here. So that was the takeaway, but let's just kind of get some detail out. So the stock is down a little bit. I mean, like in this market, the stock is down only about 5% in the after hours. It's not really a lot at all. Investors right now have become quite accustomed to seeing, if anything is not looking absolutely pristine, the stock being down 30-40%. So in that context, I mean, the stock is just barely unchanged. You've seen, if you've been following the markets for the last several days, you know exactly what I'm talking about. It's quite interesting because, Okta's been an interesting investment because in the past 6 months, the stock has not really gone anywhere. You see, it's down 30% compared to other high growth tech names. It's really held its ground really, really well. Other tech names is down like 60, 70, even 80% is not unheard of. So in that context, it's only down a little bit. It's like keeping its ground quite strongly. And I suspect that investors are still kind of very much glued to that target that they're talking about, growing their revenues at a very rapid clip. Now, last month, when I talked about Okta, I said that if this was 2021, when investors were willing to buy anything that was well positioned to grow, while embracing meaningful bottom line losses, the stock would do quite well. The problem here is that new investors coming to the stock are looking at this company, and this isn't particularly cheap at 18 times forward sales with mounting losses. Given this renewed context, I believe that there are better investment opportunities elsewhere. So the stock has come down slightly. It's not 18 times forward sales anymore, but that's the theme that I want to continue from what I concluded last month's article with. Okay, so revenues are expected to be up 38% year over year, so that's obviously quite good. It's up from what they'd previously been talking about, which was going to be approximately 36%, so it's a little bit better than what they previously talked about. Management continues to talk about the fact that over the next several years they're going to be growing at north of 35% year over year, so that's obviously very good. Now, here's the thing, right now in your focus, you're going to see that Q1 is expected to be up 55% year over year. Wow, very strong. Really, really strong. 55%, it's really, really well done. Now, the question obviously comes, if the first quarter is up 55%, that means that the latter parts, Q2, Q3, Q4, are going to be, not growing a whole lot fast. Because on average for the year, it's going to be up 38%. So it's a meaningful deceleration for the rest of the fiscal year. If you remember, Okta had the acquisition of Auth0 in May of last year. They paid 6.5 billion for that. So that led to a substantial amount of inorganic revenue growth. And you can see here starting Q2 their fiscal years are misaligned. So starting Q2 22, revenues jumped quite strongly sequentially. And as it comes to lap Q2 of this year, there's going to be a meaningfully deceleration in revenue growth rate as it comes up against a slightly more difficult comp. It's going to be tough. I think that it's going to be really, really tough for investors to be rewarded here. You got one more quarter of strong growth, and then after that, it's going to be tough for Okta. Okay, so on the other side of the equation, I think it's quite interesting to see that billings were up very strongly. Billings were up 91% year over year. So really strong billings. As you remember, you want to see billings typically slightly higher than revenue growth rates. That means that there's more revenues to be recognized over time. In this case, billings are so much stronger than the revenue growth rate that's really something that's quite bullish, and a lot of investors will no doubt be anchoring themselves to that. So what Okta actually does, so Okta is an identity platform. It has this product which is called a single sign-on, and this flagship product of them allows you to get onto any device or any application or any platform with a single sign-on. So you can, if you know the frustration of you kind of typing in your password here, there, everywhere, it's like you just get onto the Okta platform, and that connects you up to whether you're using, let's say, a CRM or whether you're using a workflow platform. It just connects you up. Whatever platform you're going to use, like Zoom, whatever, it just connects you up instantaneously. So it's going to replace a lot of the legacy identity access management systems that companies have. So they talked about on the call, there's this mega trend of in the digital transformation. As obviously, if you invested in Okta, you already know all about that. They also talked about, as you would expect right now, that companies are increasingly having to work in a zero trust environment, and the backdrop that we've seen in the last several days about security concerns. So with that, of course, we're going to put a lot of focus on that. So yeah, there's no question that the trends are there. There's no question that the tailwinds are strong. Just a question of whether Okta can drive that revenue and be profitable. And that's really a different question mark altogether, because when it comes down to it, Q4 was a negative 6.2% operating margins. Okay, so this is a non-GAAP figure with everything added back, stock-based compensation, etc. This was compared to in the same period a year ago, where it was profitable 3.4%. So last year, profitable 3.4% non-GAAP operating margins. This year, it has dropped to negative 6.2%. So it's really tough to see that really strong really strong turn to a negative profitability. That's unavoidable, and I think that the question now becomes, when over the next several years will Okta actually report clean profit margins? Because the guidance for fiscal 23 is looking for negative 10%. Okay, so so they finished fiscal 22 with negative 5.7% operating margins, and it's guiding for negative 10%. I know that they're kind of lowballing and all this and that and the other, but when it comes to it, it's moving in the wrong direction. Even if they end up with negative 8% on the operating margins, I mean, it's going to be difficult for anyone to say that this business is becoming anytime soon strongly profitable. Now, management talks about, by fiscal 26, we're going to have 20% of free cash flow margins, okay? Fiscal 26, 20% free cash flow margins. Now, just remember the fact that they're already guiding for fiscal 23. Fiscal 23, the free cash flow margin is going to be a few percentage points worse than it was in fiscal 22, okay? So in fiscal 22, the free cash flow margin was 6.7%. So they're talking about being approximately 2% lower. So you're looking at approximately 4.7% free cash flow margin. Even if you say 5% free cash flow margin, that's for fiscal 23. There is really no chance that I can see from after fiscal 23 that going into fiscal 26 that they're going to be with 20% free cash flow margins. I don't see that path. So the other thing that I think is quite interesting is they talk about on the call that there's this large TAM of 80 billion in total addressable market, but if you're not able to grow your revenues and be profitable in this market, you're not going to get rewarded for that. So I think that's something to kind of keep your eyes on. Paying 16 times forward sales for this business is probably a bit punchy. So I'm not talking about people that are already entrenched and committed to their views here. I'm talking about new investors coming to stock, looking at the story with fresh pair of eyes. It's difficult for them to get excited to pay 16 times forward sales for this business when there are so many other businesses out there that are priced at lower, let's say 10 times forward sales, and easily growing at north of 40% compounded annual growth rate. So it's going to be difficult for new investors to object, to look at this in a dispassionate way and rationally argue that this is the one investment that they're going to deploy capital towards. If you want to find out what kind of names I'm buying, don't forget to check out my marketplace. It's called Deep Value Returns. You can see right there above the screen. Come on board, check out what other people said, check out my reviews, and yeah, I highlight for you high quality, actionable investment insights. Thank you so much for listening. See you next time. Bye bye.